Shall we begin now? So, are you there?
Hello.
So, am I audible?
Yeah. Am I audible now?
Yes, sir, you're audible now. I think we can
Yes.
begin now.
Yeah, we can start. No issue, ma'am.
Hi, everyone. Very good evening to all of you. I, Pranjal Arora, on the behalf of Complete Educating Team, welcome you all for our today's live webinar on income tax for trust in NPOs. The speaker for today's and tomorrow's webinar is CA Nagarjuna. He is a practicing chartered accountant. He underwent his articleship in the firm Ramachandran and Murli, Chennai. In the year 2012, post qualifying his CA, Sir joined Eastman Exports Private Limited, Tirupur, a leading exporter of hosiery garments in the country, and served as a senior manager taxation for 5 years. After that, in 2017, he joined the firm Ramachandran and Murali as a partner and started branch in Tirupur, from where he did his articleship. There, he was handling direct and indirect taxation of individuals, corporates, charitable trusts, NGOs, and various other businesses. Sir has also addressed many seminars, career counseling programs, and events, and he is actively engaging with the students, especially government school and college students. He is also serving as a co-opted member to committees of SIRC of ICAI Tirupur branch. Sir is also a professor of practice in the Department of Commerce at Periyar Maniammai Institute of Science and Technology. So, this was a brief introduction of our today's and tomorrow's speaker, CAG Nagarjuna. Over to you, sir. You may start with the session now.
Yeah, thanks for the nice introduction, ma'am. And good evening to one and all who are present here. So before getting into the session, getting into the topic, I would like to thank Arun sir and educating team for giving me such a nice opportunity to get learning from the knowledgeable educating family members. And after a high tea, I am coming as a night watchman today for this session. Hope I'll get not out during this today sessions. So I can share my presentation here.
Yes, sir. You've been provided with the sharing rights. You can share
Yes.
your presentation.
So I hope all are for all of them my presentation is visible.
So, your screen is visible.
My screen is visible right now.
Yes, and now the presentation as well.
Okay, right, fine. So
Yes.
am I audible to all? Whether anybody having any problem with the sound quality or something like that?
You're audible.
Everyone, in case if you have any questions or anything you want to put across during the session, it is
Yes.
advisable that you do so in the chat box so that we don't face any issues while
Okay.
sir is delivering.
Okay, ma'am. Okay. Thanks for the acknowledgement actually. So as far as NGOs and non-government organization in India is concerned, generally these organizations are formed under three categories. One is as a charitable or religious trust, another one is as a registered society, and another thing is Section 8 company. So these are the three structural formats under which these non-government organizations are registered in India. And based on the various other requirements or various other laws, these entities are registered under various statutes. For example, some states have charity commissioners and state authorities which has to be registered under them. So if it is a Section 8 company, registration under ROC is mandatory. If you are receiving any foreign contribution, then it has to be registered under the Ministry of Home Affairs and Darpan portal registration. So all of the NGOs which has to be registered at Darpan portal. So recently, many of them would have encountered that Darpan portal registration has been asked by the banks. No, so as per the Prevention of Money Laundering Act, This Money Laundering Act has been amended during 2023. So in that they have included the Darpan portal registration also as a KYC document for the NGOs. So that's what all the banks are asking for the Darpan portal registration. So this Darpan portal registration and income tax registration, I'm talking about 12A registrations and 80G registrations in Income Tax Act. And if you are receiving any CSR fund, you have to register for under ROC for CSR. And if you are having any taxable outward supply, then you need to register for GST. You need to register for GST. So these are all the registrations and statutory compliances for which a non-profit organization has to be followed in India. So with this introduction, today we'll get into the topic that fully related to Income Tax Act. So what are the application of income exemption available for charitable trust as per Income Tax Act 1961? This is the topic we are going to discuss about that among all the registrations which we discussed in the earlier slide. So in this, as far as non-profit organizations are concerned, if you take in the Income Tax Act, other businesses like proprietorship or partnership or private limited, so these businesses are registered and taxed as per their status of registration. For example, if it is a private limited company, there is separate law, separate sections, separate charging sections, and there are the various kinds of income. They will be charged under those kind of things. Whereas these NGOs, NPOs are concerned, irrespective of the format in which they have received, they have registered, it is registered under Income Tax Act as per the nature of activity they are doing. For example, if you are registered under a trust or under a Section 8 company or as a society, so it is irrelevant under 12A section. So these organizations are registered as per the nature of activity they will provide. There are three major types of activities. One is charitable activity, which is defined as per Section 215 of the Income Tax Act. And second is religious activity, which is not defined in the act. And third is religious cum charitable, a religious organization which can do a charitable activity also. So these three organizations enjoy the exemptions, and there are certain provisions which restrict their application of income and everything, which is common to all these three organizations. One or two provisions will differ for the religious entities. So mostly these organizations enjoy benefits under the sections 1023C and from the sections 11 to 13. So these are all the provisions which we will detailedly discuss today. So as far as the charitable and religious trusts are concerned, these are all the sections which is applicable to them. For example, section 215 is the definition of the charitable purpose. Section 224 is the income definition, which includes voluntary contribution. And section 10, income which is not included in the total income. Section 1023C, exemption for certain trusts. Section 11, 12, 12A, this procedure for registration, and these are all the sections. And section 115 TD, TE, TF, the taxability section. So these are all the sections we can discuss in detail today. So for the charitable and religious institutions, the tax exemption has two parallel methods. So income tax calculation, computation, application has two parallel methods. One is under section 1023C and another one is under section 11 to 13. So under section 1023C, there are two routes, non-approval route and approval route. Under section 11 to 13, it is registration route. So before 110/2024, which is amended in the Finance Act 2024, there were three types of two parallel methods under which three types of organizations which enjoyed the exemptions. So first one is non-approval route, So this non-approval route under section 1023C, which is available to four kind of institutions, which is 1023C, 3AB, AC, AD, and AE. What does it mean? That is for educational and medical institutions, educational institution run by government, educational institution if it is run by another, other than government, then their gross income is less than 5 crores. If it is a medical institution, if it is run by government, it is wholly exempted. And if its gross receipt is less than 5 crore, then no approval is needed. So they are directly enjoy the exemptions under section 1023C. And there is another route under 1023C, that is approval route. In that, if for example it is a medical institution, if their gross receipt is more than 5 crore, they have to get approval from principal commissioner or commissioner of income tax exemption. So similarly, if you are running any charitable trust, you can get approval under section 1023C 4, 5, 6, these sections. However, this approval route under section 1023C is withdrawn from with effective from 1/10/2024. So this approval route has been merged with section 12AB registration route. So before 1/10/2024, there is two routes. Approval route is also eligible to claim exemptions, and registration route is also available. But with effect from 1/10/2024, this approval route is withdrawn and it is merged with 12AB. So hereafter, whatever application you make for the registration under Income Tax Act 12A, so it has to be made under section 12AB. The 1023C is already scrapped, it has been withdrawn. So as far as now, there are two methods available. One is non-approval method under 1023C is available, and section 12AB registration method is available. So I have given the summary of that non-approval route sections. So section 1023C 3AB, which is applicable to whom, and 3AC, AD, AE. So you can, I'll share this slide once this session is over. You can go through this slide actually. So first, we'll see the definition. So first definition is charitable purpose. So charitable purpose is defined in under section 215. So section 215 has 7 limbs. Limb 1, relief of poor. Limb 2, education. Limb 3, yoga. Fourth one is medical relief. Fifth one is preservation of environment. And sixth one is preservation of monuments or place or object of art. So seventh one is advancement of any other object of general public utility. So first 6 limbs, we understand that this is self-explanatory. So these are all the activities which cover under charitable purpose. Among these 7 limbs, first limb comes under relief of the poor. So that relief of the poor definition is a wide definition. There are a lot of charitable activities will be coming under the relief of poor activity. So for example, if you are distributing any blankets to the poor, for distributing any providing essential commodities to the poor at a subsidized rate, giving a food to the poor. So these kind of activities, everything come under relief of the poor. And education, yoga, medical relief, preservation, everything is self-explanatory. And if you go to the 7th limb, advancement of any other object of general public utility, there is some provisions to that. There are certain conditions to that we will discuss in the next slides. So these are all the examples for the examples for the section 215. If you see relief of the poor, these are all the activities like food, clothing, and shelter, object to assist people, providing marriage expense for poor people, like that. These activities come under relief of the poor. If you take advancement of any other GPU, for example, like Bar Council, Betterment of Life, City Improvement Trust, our institute, ACA Institute, vocational training, any associations, lorry owner associations like that. So those kind of activities, those kind of associations will come under advancement of any other GPU. ஒரு ஸ்லைடு தான் தெரியுது. Sir, I think single slide is presented, I think so. Anybody having any issue with the slideshow? So what is the view you are getting, sir? Prasanna Kumar, sir?
I'm getting your next slide also on the screen.
Oh, presentation. I think we are also.
I think most of them are also getting like that.
Yes, sir. Your next slide is also showing. Will it be possible for you to switch to full screen?
Yes. But we are also connected through another device, but the single slide only it is. Just
Oh,
a
okay.
moment.
Actually, your next slide is appearing on the right hand side.
Yeah,
No,
this
in yes,
is
I
the slideshow mode. It will be visible
yes,
to me only actually. I'll just check.
Prasanna Kumar sir. I hope this is what we are talking about.
Yeah.
So if it
Yes, it is
this
better
okay?
now.
Okay.
Yes, sir. It is perfectly all right.
Yeah.
Thank you.
Thank you, sir. Okay. So what does mean by any other object of general public utility? There is a provision for the seventh limb. So what does that provision says? Any other object of general public utility shall not be a charitable purpose if it involves the carrying on of any activity in the nature of trade, commerce, or business. So that means GPU cannot carry any business or activity in the nature of trade or commerce or business, and there is a condition for that also. So if you are running any business activity in the nature of trade or commerce or business, such activity the such activity is undertaken in the course of actual carrying out of such advancement of GPU, and the aggregate receipt from such activity should not exceed 20% of total receipt. That means for all other six limbs, there is no provision or no condition of this 20% receipt from the business or this kind of conditions. But if you are registered under seventh limb, advancement of general public utility, you are not allowed to carry any business activity in the nature of trade, commerce, or business. However, if you are running any the such kind of activity, so that should be in the course of carrying out of such advancement other object of general public utility, and the total receipt from that activity should not exceed 20% of the total receipts during that year. So you can do a business or trading activity where that should be in the advancement of other object of general public utility, and their aggregate receipt should be less than 20% of the total receipt. So there is an Supreme Court judgment regarding this. There is a landmark judgment in Ahmedabad Urban Development Authority case. So it is a very big case and it is a very big judgment. It will running out of 100 to 200 pages. So there are a lot of matters has been addressed in this judgment. So in that, for the advancement of GPU, the Supreme Court has said that if you are running a trade, commerce, or business activity, and your activity is on a cost basis or nominally above the cost, that cannot be considered as a trade, commerce, or business activity. That can be considered as a charitable activity. So that what they are telling means, for example, if you are running a lorry owners association, so that lorry owners association is deciding that we'll purchase the spare parts from the vendor and we'll sell it to our members on a cost to cost basis or on a small margin amount, then this will not be considered as a trade, commerce, or business activity. This will be considered as a charitable activity. So that is what their this judgment is all about. And so I have given a checklist of what are all the steps to identify the advancement of GPU, whether it is coming under trade, commerce, or business activity, or it is a charitable purpose. So first we have to check whether the trust falls within the last limb. So you have to check your registration also, whether you are registered under seventh limb or all other six limb. So if yes, you have to check whether it involves any activity in nature of trade, commerce, or business, or rendering any service in relation to trade, commerce, or business. If yes, this trade commerce is undertaken in course of actual carrying out of the object of the trust. If it is not supporting to the object of the trust, then provision 215 is violated and specific violation is occurred, and there is a chance of cancellation of your registration. And if it is for the objects of the trust, then we have to check whether the charges are significantly marked up over the cost, or it is a nominal profit or cost to cost basis. If it is a significant, there is a significant markup on the cost, then you have to check whether the quantum of business is more than 20%. If it is more than 20%, then this is a violation of provision 215. If the charges what we are collecting from our members is on a cost to cost basis, or it is on a nominal profit, then it will be considered as a charitable activity, and it will be subject to section 11(4)(a). So that 11(4)(a) we'll discuss in upcoming slides. So this is a checklist you can check for the advancement of GPU limit. So for all the organizations, trust and NGOs to claim the exemptions under section 11 to 13, under section 1023. So whatever I am talking, mostly I am concentrated about the 11 to 13, and all those provisions will be applicable to the 1023C registered entities also. Only hardly one or two provisions. Most of the provisions all are similar to 1023C. So here, to claim those exemptions, the majorly 5 conditions has to be satisfied. So first condition, your organization has to be registered with the Commissioner of Income Tax Act. That means 12-year registration or 1023C approval you have to obtain. So books of accounts has to be maintained. There is a separate rule which is prescribing the manner, mode, and for the period for which books of accounts has to be maintained. So books of accounts has to be maintained as per that rule. So, and these books of accounts has to be audited by a chartered accountant. That audit report has to be filed on or before the due date. This organization has to file the income tax returns within the due date. So as far as this year is concerned, the income tax return due date has been extended up to 10th December 2025. And the application of income should be within India. So all the application of income towards the object of the trust should be within India, should not be outside India. So these are all the 5 major conditions which have to be fulfilled to claim the exemptions. So books of accounts, as per rule 17AA, it prescribes the manner of keeping and maintaining the books of accounts. So the manner is spelled out that in written form or in electronic form or in digital form, or as printout of data stored in electronic form, or in digital form or any other form of electromagnetic data storage device. So these are all the kinds of books of accounts you can maintain, which is already prescribed by 17AA. And the second point is very, very, very important point. Place, address of keeping and maintaining books of accounts. There are 2 possibilities of maintaining books of accounts. One is in the register office of the trust. Another one is other than the place of the register office of the trust. For example, if a trust have 10 to 12 schools, or they are having various churches like that, so books of accounts will be maintained in those schools, the premises of those schools, which is not a registered office. Then what we need to do? So if you are deciding other place as a place to maintain the books of accounts, other than the register office as the place to maintain the books of accounts, a resolution has to be passed, and that such address resolution has to be intimated to AO within 7 days from passing of the resolution. So within 7 days from passing of the resolution, this this change in the or the place where which the books of accounts has to be maintained has to be intimated to the AO. So within 7 days from the passing of the resolution, this is very, very important. And period for keeping and maintaining. So period for keeping and maintaining the books of accounts is for 10 years as far as the this thing is concerned. It is for 10 years. Can anybody say why it is 10 years? In Income Tax Act, if you see all other for all other assesses, this books of accounts is for 8 years. For if you take GST, it is for 6 years. Why it is 10 years? Can anybody say? You can comment in the chat box. Sir, I'll take the questions at the end of this session. So whatever questions, I'll note it down. I'll take these questions at the end of the session. Okay, so this 10 years, this is also in the Prevention of Money Laundering Act. So it has been amended that the books of accounts and records to be maintained for 10 years. That's what the logic behind that, to maintain the books of accounts for trust for 10 years in this rule 17AA. So these are all the documents and books of accounts which has to be maintained as prescribed by Rule 17AA. There are 18 types of books of accounts. This we will discuss in detail on tomorrow's sessions on Form 10B. So these are all the sections and provisions and explanations which is discussed in section 11 for the trust and the NGOs. So before going into the application of income, I would like to take you through on the computation of income. See, for all other businesses, for all other computation, statement of income or memo is altogether different from the computation of these charitable institutions or institutions registered under section 12A. For businesses or for the partnership firm, we'll be starting our computation with the profit before tax. So from the profit before tax, we'll allow the allowances, we'll disallow the disallowances, add the depreciation, deduct the depreciation, we'll arrive at a taxable profit, and on that we'll calculate the tax. However, these NGOs or NPOs are concerned, we'll be starting from income. So whatever income you have shown in your income and expenditure or your receipts and payments account is different from the income which we are going to compute in the computation. So for all these kind of entities which is registered under section 12A of the Income Tax Act, we'll be starting from the income part. So we'll be starting from the income part. So how this income has to be computed, we'll discuss in next slide. From this income, we'll deduct the application of incomes. So application of income is nothing but expenses. There we'll be termed it as expenses. Here it will be termed as an application of income. So the application of income on revenue expenditure is allowed. Capital expenditure is also 100% allowed, that we will discuss later. And there are certain disallowances that has to be disallowed, and there are certain allowances that has to be allowed. And this organization can set apart up to 15% of their income every year, up to 15% as a deemed application. So these are all the application of income. For example, a trust receiving 1 lakh as a donation or income during the year has to mandatorily spend 85% during the year. 15%, up to 15%, they can set apart without any restrictions, without any conditions. So they need not spend that amount. They can consider this as a deemed application, and they can keep it aside. So for example, if you are receiving 1 lakh as an income, you have to spend 85,000 rupees, and 15,000 up to 15,000 rupees you can set apart. I'm receiving 1 lakh income. I have spent 90,000 rupees, means this 10% you can set apart. This 15% is not a standard deduction. This is a deduction up to 15% you can claim. But you have spent 90% means up to 10% it is available. You have spent 95% means up to 5% it is available. So up to 15% you need not spend this. And so if your total application of income including this 15% set apart is more than your income, then no need to do anything, and no carry forward or set off of losses is allowed. If it is excess spent, this is excess spent only, that has to be that has to be dealt in the current year income, in current year computation itself. And if you have spent in short, for example, I have received 1 lakh rupees as an income, and I spent 75,000 rupees, and 15 percentage comes to 15 percentage I have set apart. Now in this case, total application of income is 90,000 rupees, and there is a shortfall of 10,000 rupees. So for this 10,000 shortfall, there are three options available. One is either you have to pay tax, otherwise you can spend it on the next year or in the year of income, during the year in which you are receiving that income. So that option is available, or you can spend it in next 5 years. So there are three options available. To spend it in next year, you have to file Form 9A. We can discuss in detail. To spend it in next 5 years, we have to file Form 10. That is also we can discuss. So this is the summary of the computation, which has income, application of income. If there is an excess, no need to worry. And if this is shortfall, that has to be either has to be tax paid or has to be accumulated to next year or next 5 years. So this is the broad summary of the income computation. Okay. So first of all, we'll discuss about what is income. So as far as other assessees or other tax treatment are concerned, in Income Tax Act, there are 5 heads of income. So every assessee is taxed as per the 5 heads of income, as per the methods, as per the allowances and disallowance prescribed in those sections will be taxed. However, as far as these 12 registered concerns are concerned, that income should not be understood in the 5 head sense. It should be understood in the commercial sense. So where it is defined, there is a CBDT circular which is dated during 19th June 1968. It has prescribed that how the income has to be computed. So here the 5 heads of income will not be applicable. So income should be understood in a commercial sense. If you are receiving any rent, if you are receiving capital gain, everything will be considered all put together in a single line, and it is considered as an income. It should not be taxed under the 5 heads of income. And here, irrespective of the method of accounting you are following, this application of income, these expenses are allowed only on the actual payment basis. Like section 43B, it is allowed only, certain expenses are allowed only on cash basis. Here, all the expenses, all the application of income are allowed only on the payment basis, not on the accrual basis. And as far as the capital expenditure are concerned, as far as the capital expenditure are concerned, here you can claim 100% of the capital expenditure during the year it has incurred itself. For example, current year I have purchased an ambulance for 20 lakh. We can claim whole 20 lakh as an expenses during the current year itself. So we need not claim the depreciation like for the all other assessees. So for example, there you will be claiming 15 or 20%, 10 or 15% depreciation only for the capital assets. Here that is not applicable. You can claim total capital expenditure also as an application of income. Yes, you can opt for depreciation also. That is an option for the assessee. You can claim either depreciation or 100% of the capital asset. That is your choice. So if you are opting for claiming depreciation, then the depreciation has to be reduced from the income itself. Before calculating that 85%, that has to be reduced from the income itself. And here the income tax paid. So whatever the tax paid is also allowed to deduct as an expense from the income. So for all other part of the income tax act, income tax paid is not an allowed expenses. It is not allowed to deduct from the income or profit for all other assessees. But however, this trust or NGOs are concerned, you can claim income tax also as an expenses. This has to be deducted from the income part. So after deducting the depreciation and income tax, income has to be calculated. From that income, 85% has to be spent. Here there is an item called administrative expenses. There are two views on that. So department is taking a view that these administrative expenses also to be deducted from the income, and after that 85% has to be calculated. However, certain other professionals who are dons in this trust and NGOs, they are taking a stand that these administrative expenses are also a project expenses, which is also related to the project or the charitable activity which the trust is providing. So they are considering this as an application of income below the line. However, department is taking a view that this administrative expenses has to be deducted from the income, and the income is after deducting this administrative expenses. So this is the concept of income. To summarize, income the 5 heads of income is not applicable for the trust. Income should be considered as in a commercial sense. There are certain items which has to be deducted in the income part itself before making the 85 percentage calculation. Okay, so these are all the points we are going to discuss. I have given a summary of these points which we are going to discuss today. So first one is this income applied for religious charitable purpose, that 85 percentage thing. And second one is this income accumulation up to 15 percentage. And what is the condition for accumulation to next year or year of receipt that we will discuss today. And accumulated for specific purpose up to 5 years that we can discuss today. About corpus donation, mode of investment prescribed, and treatment of application from loan or borrowed funds that we can discuss today. Capital gains, donation, what is the case for donation to other trust having same object. If you're donating to other trust not having the same object, so what is the treatment for donation towards corpus of the other trust. And what if business by a trust benefit to specified person treatment, and anonymous donation claiming of depreciation provisions. What is the stand about the section 40A 1A disallowance and 40A 3 disallowance? So what about the applicable section 56 to 10? And what about set off of loss, whether we can claim or not? So conditions for cancellation of registration, in what cases the exemption can be forfeited, and the specified rates, which are what are all the rates available for taxation for NGOs, and this tax computation method in detail. So these are all the points we are going to discuss in another half an hour or 20 minutes. So first of all, application of income. So that application of income is that income must be derived from the property, and such a property should be held under trust. The trust should be wholly for charitable or religious purpose. Such income is applied or accumulated for the application to such religious charitable purpose in India. That means that income should be derived from the property. Here property means, it doesn't mean only the immovable property. It means all like cash, bank, FD, everything, movable properties also considered as property here. So such a property should be held under trust. It should be wholly for charitable and religious, and it should be accumulated within the India, spent within the India. Sir, I'll come to this later, sir. Prasanna Kumar, sir. We'll discuss while during the corpus donation and everything. So these are all the components of income of every charitable trust. There will be from charities, that is donation, you will be receiving a voluntary donation and corpus donation. There will be anonymous donation and non-anonymous donation, and there will be activities, income from the activities, and from the business activity, investment activity. For example, you would have been invested in the fixed deposit, you will be receiving any income from that, you will be receiving dividend like that. And trust may have some business activity which is coming under section 11(4) and 4A. And there are other income, rental income and capital gain income. So these are all the broad categories of income which a charitable or religious trust will receive. So contribution, voluntary contribution, we can bifurcate into two. One is the corpus donation, and another one is the regular donation. So there are two types of donation: corpus donation and regular donation. For corpus donation, there are certain conditions to spend, and there are a lot of changes has been taken place, lot of amendments has been taken place in the area of taxation of NGOs during last 3-4 years. So from Finance Act 2020, there are amendments and updations in every Finance Act. From 2020 to last budget, there are various amendments and various changes, and the major change is in the corpus donation part. So here, what does mean by corpus donation? If you are receiving any donation, stating that as a corpus donation, specified that as a corpus donation, specific direction is given to treat that as a corpus donation, that is called corpus donation. So if it is a corpus donation, that has to be invested in section 11(5) mode. If it is invested in section 11(5) mode, it is exempted. If it is not invested, then application of income is not allowed. If it is a voluntary contribution, then you can, according to the application of income, you can treat that voluntary contribution for the exemption. If you have spent 85%, then you are allowed to this thing, and if you are not spent, you have to follow those other accumulation conditions. So this deemed accumulation, 15% of accumulation of income. There is no time limit for this accumulation to spend. You are not mandated to spend this accumulation. You can accumulate for any number of years. There is no need of entry required in books for this. This will not result in deficit. So this 15% has to be calculated on the gross income, which we have discussed, after reducing that income tax, depreciation and administrative expenses. So this whether this will include a corpus donation. See, corpus donation is exempted under section 11(1)(d). So while calculating the income itself, it is exempted. So once the corpus donation is exempted, so you have to calculate this 15% on the other the income from other than the corpus donation. So this capital gain is also treated as an income. So we can include the capital gain as an income and we can calculate this 15%. So this is the general accumulation. And if there is a shortfall during a year, for example, I have received an income of 1 lakh rupees. I have spent only 75,000 instead of 85,000. So why I have not spent the 10,000 means I have received that donation, that income. I have received that donation on the last day of my financial year, or if there are interest income for there are interest income. For example, accrual interest. If you have any bank interest, FD interest, that will be an accrued interest. For claiming TDS purpose, we would have accounted in our books of accounts. That is not actually received, however accrued. So to claim the TDS during the year, we would have been accounted. So this section 11(1) explanation 1(2) is applicable. So you can accumulate it to next year or year of receipt if application falls short of 85% of income due to any income not received during the year. Example, any fixed deposit interest which we have accounted as an accrued interest and it is not received during the year, or any other reason. For example, I have received the donation on the last date of the financial year. So you can opt to spend such income in the year of receipt of income or in the subsequent year. So we have the option to spend. If it is not received during the year means in the year of receipt of income we can spend. For any other reason means the shortfall has to be spent in the subsequent year. For this, Form 9A has to be filed. This has to be filed before the due date of filing of the returns. So what will happen if Form 9A is not filed before the due date of filing of the return means, so with this belated filing, we can get a condemnation of delay with the proper reason. So very simple. If you are not spent the amount up to 85%, that shortfall can be spent in the subsequent year or in the year in which receipt of in which the year you are receiving the income. So for that, Form 9A has to be filed. And we have received the income, but we are going to spend it for a project, for a bigger project, for example, like construction of a school, construction of a hospital, like that. So I'm not able to complete that in a single year. So it will take 2 to 3 years to complete that project means whether I'm eligible to accumulate it to up to 5 years, that is also, yes, that is also eligible. So if I am receiving an income, I am accumulating it for a specific project. That project will not be completed within 1 or 2 years. Then you can accumulate it for next 5 years. So for that you have to file Form 10, and purpose of accumulation and period of accumulation has to be specified in this Form 10. For Form 9A, that purpose and period need not be specified, but Form 10, purpose of accumulation and period of accumulation has to be specified. You can give multiple purposes also. For a say, for example, I'm having 1 crore rupees of amount. For 50 lakh, you can give a specific purpose, and for another 50 lakh, you can give a specific purpose. So reproduction of general objects, it is not advisable actually. You have to mention the specific object for which we are going to spend it. So here a copy of resolution is must. We need not be enclosed at the time of filing of the return, but resolution has to be passed for which purpose it has to be spent. And in this resolution passing date, there are two views. certain professionals taking a view that this resolution has to be passed on or before 31st March. Certain professionals are taking a view that this can be passed before the return filing or before the AGM. So there are two views. At least what we suggest is you make a resolution on or before 31st March. At least if you miss the 31st March, you keep a place in the minutes book. You keep at least you put a blank column for this also, and so that we can insert on a later date whether what is the purpose if we decided at the time of filing of the return, we can insert there. And very important condition, this accumulation, whatever we are accumulating for next 5 years, that has to be invested in the mode specified in under section 11.5. So this is very important. You can accumulate up to next 5 years. Form 10 has to be filed. So this question, Swapnal Jangam sir. So as per the act, this form 10 has to be filed within 2 months before the ITR due date. But however, there is a circular, sir, that we will discuss in the next slide if you see. So as per that circular, this form 10 and form 9A can be filed on or before the filing of return. Not the audit report, we can file before the filing of return. For example, if you are filing the return on 31st October, you can file this on 30th October itself. No issue at all. There is a circular number 6/2023. Okay. So if this accumulation, which is we have accumulated to next 5 years, applied for other than the specified charitable or religious purpose, or it is ceased to remain invested in a specified mode, or it is not utilized for the specified purpose within the period of accumulation, then this has to be taxed. So for example, up to 5 years we have not spent the amount, not utilized the amount means now it has to be taxed on the 5th year. Earlier it was taxed in the 6th year, now it is taxed on the 5th year. So if you are not utilizing or it is ceasing to remain invested in 11.5 or it is not spent towards the object of the trust, then this will be taxed at a flat rate of 30% under section 115 BBI. So no set off or deficit of relevant area is applicable. So donation to other trust is not permitted, only permitted if trust is being dissolved. So this is what I am talking about, sir. I'm just summarize this. If you are accumulating for the next year, you have to file form 9A. Two reasons: income not received during the loan previous year, any other reason. So here, as per the act, the due date is 31st August. However, there is a circular called circular number 6/2023, 24/5/23. This is given for the specific assessment year. However, we are taking this circular for subsequent assessment years also. There is no notice or there is no dispute from the department. So we are following this circular, sir. So as per this circular, the due date is before filing the return, ITR return. Here, this circular is here, sir. You can refer my slide. So this is form 9A. Here it is very simple. We have to give the details. What is the amount not spent? We have to mention it here. If it is for any other reason, the reason has to be given. If it is not received, no reason has to be given. So this is form number 10. So resolution has to be passed here. Resolution has to be passed for 5 years or lesser year, whatever as per your organization's requirement. So we have to mention the purpose, what purpose we are going to set apart. We have to mention the section, starting year, ending year, period we have to mention. Corpus donation. So very important thing, because there is lot of changes in this corpus donation, lot of explanations given in the memorandum of finance act itself. There are many clarity has been given. So that what does mean by corpus donation? Contribution made with a specific direction to form part of corpus donation. So you have to get a corpus letter from the donor that specifically mentioning that that should form part of corpus. So this corpus donation has to be invested in the mode specified in 11.5. So whatever the mode specified in 11.5, it has to be invested. this cannot be used to donate to other trust corpus. So with effect from 1/4/28, that has been restricted. You cannot donate it to other trust for corpus. And from April 1st of 2022, a trust cannot spend the amount from the corpus. If it is spent from the corpus, it is not treated as an application of the income in that year. And what you have to do, the same amount has to be repaid, replenished, put back into corpus from non-corpus income within the time limit of 5 years. So during which year you are putting it back, that year you can treat it as an application and not on the year in which you are spending it out. So this is the main amendment in the Finance Act. So corpus, you are not allowed to spend it from the corpus. If you are spending from the corpus, then within 5 years you have to repay back that amount from the non-corpus income. So during the year in which you are repaying back, that will be allowed as an application. And during the year you are spending, it is not treated as application. Yes, sir. Keeping the amount in bank account will fulfill the specified investment mode. It is a permissible investment in 11.5 that we'll discuss. Okay, so what about the donation if I am receiving in kind as a corpus? You see, immovable property is covered under section 11.5 permissible investment. So immovable property, if you are receiving as a donation as a corpus, then it is allowed. Other assets like ambulance, medical equipment, jewelry, this is not a permissible investment under 11.5. So this is advised to get as a regular voluntary contribution instead of corpus contribution. So this is the conditions for corpus. I have given as a chart. So whenever you are replenishing this corpus, you are allowed to claim as an application of income. Within 5 years, you have to repay. If it is more than 5 years, you are not allowed to claim it as an application. These are all the other condition has to be satisfied. Corpus cannot be given as a corpus donation to other trust. No cash transaction is allowed. TDS to deduction 40A IA is 40A 1A is applicable. On it should be on an actual payment method. No carry forward loss is adjusted. There should be no benefit to the specified person. This application should be within the India. Okay, these are all the 11.5 permissible investments. So important thing is this post office savings bank account, any bank account, any account in the scheduled bank savings account or current account is also covered under the 11.5. So that corpus account, merely you are keeping it in your bank account itself sufficient to fulfill the conditions of 11.5. So other things you please go through. So these are the important, and investment in immovable property is covered under section 11.5. However, movable property is not covered under section 11.5. This query will come later, sir. So investment in immovable property is also covered under section 11.5. But movable property is not covered under 11.5. So be careful on that part. Okay, application out of loans and borrowings. This is also very important topic. So this is also, there is an amendment in this. For example, this loans and borrowings part, a hospital is buying an ambulance for 15 lakhs. So I'm taking a loan of 10 lakh and I'm putting an down payment of 5 lakh. So I'm taking a loan of 10 lakh and during the year, I am repaying the loan of 1 lakh. What is the amount allowed to claim as an application? Can you comment in the chat box? Anybody can comment in the chat box. See, my total cost of the ambulance is 15 lakh. I purchased. That loan is 10 lakh and my repayment during the year is 1 lakh. So my down payment is 5 lakhs. So what is the amount we need to claim as an application of income? Can anybody comment on the chat box? 6 lakh. Yes, very good. So that's what I'm coming to say. So here the application of income is claimed as per the actual payment method. So if you are taking as a loan means that repayment can be claimed as an application and not the loan amount. So not the cost of the asset or not the value of the loan taken. So you have to take See, 5 lakh down payment we have made, and 1 lakh is the repayment of loan. So totally 6 lakh spent during the year. So next year, if I am making a 2 lakh of repayment, including principal and interest, you can claim that 2 lakh as an application of income. However, if that loan is for 7 years, so what is the scenario here? It is not allowed. Only loan repayment up to 5 years is allowed. So this is a very big issue for many of the hospitals and schools, which they are having a loan for 10 years or 15 years term. But the law is such that you are not able to claim the repayments which is made after 5 years. So here professions what they are taking is, there are two views for this also. Some professors are taking that they are claiming depreciation in this case from the inception itself. So every year we can claim the depreciation that can be continued up to 10 to 15 years. Some professors taking a view that, I don't suggest that, but some of them taking a view that first 5 years they are claiming that repayment of loan, and sixth year they are arriving at a cost of the asset as on that date, and from that sixth year they are claiming the depreciation. These are two views. This can be taken as per their professional judgment. So that's what I just need to highlight this. So this is a simple example for that. So whenever you are repaying the loan during that year, we have to claim this as an application of income. So donation to corpus of other trust is not eligible to claim as an application of income. So capital gain. So capital gain is concerned, actually the expenses towards the capital assets are claimed 100% during the year of incurrence itself, year of payment itself in the trust and NGOs. So our books of accounts will reflect that this capital asset value will be zero in case of income tax filing uh, for the income tax computation. So whenever you are selling that asset, total consideration will be the capital gain. So whether this capital gain is allowed, or whether this capital gain we can claim it as an expense, or we can claim it as an application. Yes, this income, if this capital gain is reinvested in another capital asset, it is allowed. Actually, there another capital asset means even a fixed deposit is also a capital asset. Will there is a time limit to hold that asset means there is no time limit to hold the asset in this case for the trust case. So minimum period what the holding is ideally expected is to hold at the end of the year. So investing in fixed deposit is also a capital asset. There is no time limit to hold this asset, and also the reinvestment can be made within the same financial year, or with this capital gain you can apply it to the regular object of the trust. That is also allowed. That is also an, other than fixed asset, you can apply it to the regular application of the trust. That is also an allowed. So no time limit for this. So if you are not able to utilize during the year, you can opt for section 11(1) accumulation, or section 11 explanation 1 to accumulation also, that is available for capital gain generally. So if you are going under depreciation route, the same scenario. So the difference of the amount will be considered as an income, and you can reinvest it, and that is an exempted under section 11 only. So this is a simple book adjustment scenario. So for this scenario, this is the regular business and this is the trust. So for regular business, this cost of acquisition will be 100. You'll be claiming 40 depreciation, WDV in book 60 rupees, and you will be claiming 40 as a depreciation. And if at the time of sale, your sale consideration will be 45, there will be loss of 15 rupees, and cost of the use of asset will be 55. Here, if you say, if you are claiming this 100% as a deduction, your cost will be nil, and this total 45 rupees will be the income for the trust. So set off of loss is not allowed. So every year, if you have any excess application, so that shall not be accumulated, and that shall not be adjusted during the next year's income. This has to be adjusted to the previous year income or previous year's accumulation. So this is what the depreciation we can claim. We can opt for the depreciation. So you can claim only under SLM method. SLM method is only allowed, not on the WDV method. So this depreciation is deducted from income, not on the application. So and if you are transferring your funds to another charity or transferring your funds to another trust means only 85% of your donations is eligible to allow as an application. For example, if you are donating 100 rupees to another trust which is having the same object or similar object which is registered at 12AB, then only you are allowed to claim it as an application. 85% only allowed to claim it as an application. If you are donating to another trust which is having the same object, you are allowed only to claim 85% of the donation as an application. So that organization has to be registered as a 12AB registration, and it should have a similar object. No transfer of funds from charitable organization to religious organization. So charitable entity should not transfer funds to religious organization. So business by a trust, there are two important sections, section 411(4)(a) and section 11(4). There are two sections that talks about the business by a trust. For example, in earlier days, certain persons will be donating the business as it is to the trust actually. So they're donating business itself as a donation to the trust. So that profit from the business will be taken and spent for the object of the trust. So that is a case. There is a scenario on this case that will be coming under section 11(4). And there is a section called 11(4)(a), business incidental to the object of the trust. For example, if we are running a hospital, we will be running a pharmacy. If you are running a school, you will be running you will be selling books, stationaries, and printing, those kind of things. So these will be coming under incidental to object of the trust. If the business itself given as a donation to the trust, that will be treated as a business by a trust. Business is a property of the trust, that will be coming under section 11(4), and incidental business will be coming under 11(4)(a). So in this 11(4) case, the business itself given as a donation to the trust, the net profit from the business should be treated as income. For example, that business is doing a turnover of 2 crore rupees, having a profit of 20 lakh rupees, and that 20 lakh rupees has to be included in the income. On that income, we are going to calculate that 85%. So this business net profit has to be included to the income. However, for the incidental business, total turnover can be included as income for the trust. So that is the difference between both the two. If both the turnover of this business exceeds the tax audit limit, then tax audit is compulsory for this business. So for this trust, we have to file both tax audit and Form 10B, Form 3CD and 10B. So for these businesses, separate books of accounts has to be maintained, and that separate books of accounts is not maintained, then it will lead to cancellation of the business trust. So these are all the provisions of those two sections. So anonymous donation. What does mean by anonymous donation? So this we can I'll answer after completing this presentation. I'll answer this question, sir. So what does mean by anonymous donation? Sir, give me 15 minutes, sir. 15 minutes we can conclude this. And we'll go for 5 minutes. Is it fine, sir? 5 minutes for question and answer. We can conclude it in 10 to 15 minutes. Is it fine? Okay, so anonymous donation is received without identification. So what does mean by anonymous donation? There should be some identity. So what is that identity? Whether PAN card is needed, whether Aadhaar card is compulsory? No. So section 115 BBC3 says that anonymous donations does not maintain the record of identity indicating the name and address of the person making such donation. So we should have some name and address of that person. So if you are receiving any anonymous donation in excess of 5% of the total donation received by the trust or institution, or 1 lakh rupees, whichever is higher. So If you are receiving anonymous donation, if it is within the limit of 5% donation, then that is allowed. If it is more than 1 lakh rupees, if it is 1 lakh rupees or 5%, whichever is higher, then this is anonymous donation is allowed. If it is more than that, tax will be charged at 30% plus surcharge plus cess. So there is some exemption for religious trust. This anonymous donation is exempted for religious trust, so they can get an hundi collection or this undial collection like that. They can get this anonymous donation. So only condition is if you are receiving any anonymous donation, so if that anonymous donation is within the limit of 5% or 1 lakh rupees, whichever is higher, then no problem. If it is more than this, tax has to be paid on the over and above the limit. So I have given a chart for whom this is exempted, for whom this is taxable. So the next benefit to specified persons treatment. So whether any part of the income or property of the trust is directly or indirectly benefited to any related persons. So this is about related party transaction. If any benefit is given to the related party which is unreasonable in an not in an arm's length transaction, then you will be taxed at 30% under section 115 BBA, and for first instance 100% penalty, and for subsequent instance there will be a 200% penalty under section 271 WAE. So this benefit to the specified persons is very important. So while certifying our audit report, we have to check the related party transaction whether those transactions are under arm's length or not. So other points, there are two sections from PGBP is applicable to this organization also. That is only two sections, section 40A1A and section 40A3A. So if you are deducting if you are paying any amount which is not deducted TDS, then 30% application has to be disallowed, and if you are paying more than cash 10,000, that has to be disallowed. However, in the income tax return, if we are disallowing this 40A1A and 40A3, directly tax will be calculated for that amount. However, law does not say that, income tax law does not say that to tax this, because for example, I am receiving an income of 1 lakh rupees. I have spent that 1 lakh rupees. In that 1 lakh rupees, a 30,000 payment for which TDS is not deducted means I am eligible to disallow 10,000 rupees. So after the disallowance also, my spending, my application, my utilization comes to 90%. So I am very much into the limit of 85%. So there is no need of calculation of tax for that. But however, as per the income tax return, as per the Infosys Tax Act, so this is calculating tax, and the tax has to be paid through cash, or it is adjusted to against the TDS in the income tax return. So regarding 269 ST, that cash donation more than 2 lakh is not allowed. Section 56 to 10 is not applicable in case of donation in kind. If somebody is giving a donation which is more than the limit specified in the 56 to, this 56 to 10 is not applicable to the institutions which they are claiming exemption under section 11 to 13. So trust with charitable objects cannot spend for religious activity. So cancellation of registration. So there is a section called section 12AB4. In that there is a power granted to the principal commissioner to cancel the trust registration. So this trust registration cancellation triggers when three types of events occur. One is the principal commissioner or commissioner identifies one or more specified violation. Second one is AO refers the case under the second procedure to section 143.3. Third one is the case is selected as the part of board risk management strategy. In this, point number 2 and 3 is not in our hand. Point number 1, the specified violation. So there are 7 types of specified violation has been notified. If you are coming under these specified violations, your registrations will be cancelled and you will be taxed under section 115 TD. That means exit tax will occur. So what are all these specified violations I have given here? You can go through this. Tomorrow we'll discuss in Form 10B these issues. And in under section 13, there are forfeiture of exemptions. So there are certain events, if it is happened, the exemptions will be forfeited. So that means what are all these events means? If the charitable trust is pending the application for the religious purpose and not for public benefit means your exemption is forfeited. So if a trust is for a particular religious community or caste, your object is for all the religious community, caste or creed, but the application is for particular religious community or caste, so your exemption will be forfeited. There is an exemption in this limb for the SC/ST backward classes, women, children trust, which they are working under these kind of activities. And if you are encountering any benefit to the extending any benefit to the specified persons, then the exemption will be forfeited. If the investment in mode other than section 11.5, your exemption will be forfeited. So who are all the specified person I have given here? You can go through this slide. So this relative definition, which is similar to all other sections. There are 4 types of tax rates for this NGOs and trusts are concerned. So section 164(2), it is for the unregistered trust and for the amount which is not spent over and above the 85%. 115 TD, this is an exit tax on the accredited income. So this will occur when 3 types of violation triggers. This tax rate is 30% on a maximum marginal rate. This maximum marginal rate is applicable for 115 TD. On 115 BBC, this is for anonymous donation. If it is an anonymous donation, 30% tax slab rate is applicable. And under section 115 BBI, there are certain non-compliances. Those non-compliances will be taxed under section 115 BBI. So I have given this as a flow chart. You can go through this. So these are all the violations or specified income on which section 115 BBI will be taxed. This we can in detail discuss in the tomorrow session of 10B and ITR. So this is the method of computing the tax. Under section 115 BBI, the slab rate is not applicable. So for the total income, you have to tax at 30%. So that is the point I'm highlighting here. So this 115 TD is also we can discuss tomorrow. So this is a summary of what are all the forms need to be filed, the purpose, when to be filed, and deadline, everything I have given. You can go through here. And what are all the rules applicable to the charitable institutions, I have given it here. This is also, you can go through this slide. So this is the format of a sample computation I have given here. So sample I have given here. Thank you all for patiently listening this session. And I would like to extend my thanks to the educating team to giving me this opportunity. And we can move on to the question and answer session. So I am ready to answer all your questions. Happily answer.
So I think we already have a few questions in the chat
Yes, ma'am.
box.
Yes, ma'am. Okay, I'll come from this. Okay, so sir, why ROC? See, if it is a Section 8 company, then we have to register under ROC. And for other trusts also, if we need to receive CSR fund, then we have to register CSR 1 form. So that's what ROC. So trust formed to manage the affairs or the assets of the author of for the benefit of his children or beneficiaries. What do you call this trust? What about that the trust carries on a business of real estate buying and selling? So these are all private trusts, sir. So this private trust will not come under this charitable activity. So private trust is dealt with some other provisions. So if any benefit to a specific person means this charitable activity and this exemption will not applicable to them. If a trust collect the development fund, can that fund be utilized for revenue expenses like scholarships to students, etc.? So the development fund, whether this is received as a corpus or voluntary contribution is the question. So that donation letter and the donor he has to mention that whether this is a corpus or not. So other than this corpus fund, they can give it for any purpose. So for that purpose, we can use it, no problem at all. If it is termed as a corpus, then we are not allowed to use this fund. This has to be invested under section 11.5. So other than regular voluntary contribution, then they can give it for any other direction, no issue at all. So this form 10 I have already covered in the slide itself. So keeping in an amount in bank account is considered as section 11.5. And amount used for purchase of capital shown as application purpose, and depreciation also claimed on that, where to reverse and report that depreciation. So this you cannot claim both. Either you have to claim depreciation, or you have to claim the application. So we are not eligible to claim both. If you are claiming both, in the regular computation itself, you can disallow the depreciation. Or while calculating the while calculating the profit, or while calculating the income, so from the income and expenditure, while bringing the expenses, you leave the depreciation itself in the income and expenditure, bring all other expenses to the computation. That's it. Investment in mutual fund considered as application. Sir, I have given the list of section 11.5 investments. So those kind of investment only allowed. For example, if you are investing in a private limited company shares, it is not allowed. If you are buying jewelry for a temple, it is not allowed as under section 11.5, sir. So you can check this slide. So what are all the just a minute. So 11.5 given. You can please refer this slide for that. Can trust take a loan from other than financial institution? Yes, sir. They can take, no issue. I don't think any restriction on that. Other than financial institution, they can take, no problem. So receipt without this is okay. Whether interest paid to the trustee for receipt of unsecured loan can be treated as applicant, whether it is treated as section 13(2). Sir, uh, any payment or income, any benefit given to the trustee, if it is in the arm's length, if it is in the reasonable rate, for example, this interest is in a reasonable rate like an SBI rate, or lower the rate, I'll share to the educating team, sir. They'll share it to you. So these any benefit which is passed on to the trustee, which is unreasonable, which is not in the arm's length only, will be disallowed and penalized. Which is reasonable. For example, the trustee is the principal. For trustee is the principal of the school, headmaster of the school. You are paying a salary, that is very much allowed. So like that, if they are rendering any service, or if they are rendering any activity to the trust, and for that in turn we are paying to them, if it is within the reasonable limit, yes, it is allowed. We need not treat it as a section 13(12) to disallowance. So, for taking loan, we need not take permission from the ITO, sir. So if you are having any change in the object of the trust, you have to take the permission from the ITO. Other than that, we need not, we don't need the permission from the ITO, sir. So any other questions, sir? So thank you, sir. Thanks for the opportunity provided to me. So if any other question, you can note it down, and tomorrow we can discuss it. No issue at all. Over to the educating team so they can conclude this meeting, right?
Thank you so much, Nagarjun sir, for such an informative session. And everyone, we will be meeting tomorrow again at the same time for the second part of this session. And the PPTs, once the session
Hello? Hello?
Sir, am I audible now? Sir, could you please confirm if I am audible?
रंजन।
राहुल, आवाज आ रही है मेरी?
हाँ जी, हाँ जी, आ रही है।
हाँ जी. So I was just saying, I think there were some issues with my internet. Thank you so much, sir, for such an informative session today. And everyone, we will meet tomorrow again at the same time, 5 p.m. to 6 p.m. And all the recordings and the PPTs, it will be available to you on the educating portal itself, which you can access using your login credentials. Thank you, everyone. Good night. Good night, sir. We'll see you tomorrow.